You are sitting at your kitchen table, staring at a spreadsheet, or perhaps a banking app. The numbers are glowing back at you, and you are trying to solve the oldest equation in personal finance. You have a surplus of cash this month, maybe $500, maybe $2,000. The question is binary and nagging. Do you send this money to your brokerage account? Or do you use it to aggressively attack your outstanding balance? The math suggests that if your interest rate is lower than the average stock market return of 7 or 8%, then you should invest into the market. The psychology suggests you should eliminate the debt for peace of mind. But while you debate between column A and column B, there is a leak in the hull of your ship that you are not even looking at. It is not the interest rate on your student loans, and it is not the expense ratio on your index fund. It is a silent, structural overhead that has slowly replaced the concept of discretionary spending. It is the cost of buying back the time that you previously sold to your employer. Before we can answer whether you should be an investor or a debt eraser, we have to address the invisible second rent that most modern households are paying just to keep the machinery of their lives running. The wealthy know the answer to the allocation question because they understand that before you grow your net worth, you must first stop financing your own existence at a premium. When we look at the raw data of how we live, the baseline is already staggering. According to the Bureau of Labor Statistics Consumer Expenditures Report for 2024, the average household spends $26,266 per year on housing alone. That is 33.4% of total spending. We accept this. We know the rent or the mortgage is the first cost. But what has shifted in the last decade is the rigid calcification of other costs that used to be variable. Consider the logistics of moving your body to the place where you earn the money. The same Consumer Expenditures report shows that transportation now costs the average household $13,318 annually. That is 17% of total spending. When you combine housing and getting to work, you have already spent half of every dollar you will earn. And unlike the executive class, the average worker is shouldering this burden entirely alone. Data from the Bureau of Labor Statistics shows that in 2024, only 10% of private sector workers had access to commuting subsidies. This creates a peculiar financial pressure specifically for the demographic most likely to be watching this analysis, the dual-income household. We often assume that two incomes provide double the security, but statistically, they often just double the overhead. As of 2024, 49.6% of married couple families were dual income. On paper, this looks like wealth. In practice, it creates a time deficit that must be filled with money. When both adults are selling 40 to 50 hours of their week, the domestic labor that used to be free, cooking, cleaning, logistics, childrearing, does not disappear. This is where the second rent appears. It is the monthly minimum payment required to sustain a high-speed life. If you are debating between investing and paying off debt, you must first calculate your gross convenience cost. This is not about the occasional laddie. Let's look at the most aggressive component of this second rent, the care of children. For decades, this was a family absorbable cost. Now it is a second mortgage. Child Care Aware of America reported in 2024 that the national average price of child care was $13,128 per year. That is a 29% increase since 2020. But the sticker price isn't the only problem. It is the rate of acceleration. While you are hoping for a 7% return in the stock market, the cost of having someone watch your children is outpacing your portfolio. The Bank of America Institute noted that in September 2025, child care payments increased by 5.2% year over year. If you are investing money into a bond fund yielding 4%, but your structural life overhead is inflating at 5.2%, you are not building wealth. Let's pause and run a mathematical simulation to see what this actually looks like for a successful modern family. Let us imagine a couple, the Millers. They bring home a combined net income of $9,000. They feel they should be rich, but they have no time. They pay $3,000 for their mortgage, the first rent. But then the convenience overhead kicks in. They spend $800 a month on food delivery. and high-premium meal kits. Because they cannot manage the cleaning, on weekends they pay $300 for a bi-weekly service. Because they commute from the suburbs, their 2-car lease and fuel setup runs them $1,200. The math is brutal. Their fixed housing cost is $3,000, but their operational cost, the price of the conveniences required to maintain their jobs, is $4,300. They are spending more to operate their lives than to house. They have $1,700 left over. If they put that $1,700 into market, and it earns 10%, a generous assumption, they make $170 in growth first month. But if one of them loses a job, that $4,000, operational overhead does not vanish overnight. They have built a high beta lifestyle. The wealthy answer to the question of invest or debt is usually to reduce operational drag. If the Millers could restructure their life to reduce convenience, burn by $1,000 is a guaranteed tax-free return of $1,000 every single month forever. Of course, reasonable people will disagree here. You might argue that this convenience spending is not luxury, but a requirement for mental health. You might say, I trade money for time because my time is valuable. This is the most common counterargument to second rent theory. This is a seductive piece of logic, but it is often mathematically flawed. It only holds true if you use that saved hour to actually earn $50. If you use that saved hour to scroll social media or watch streaming services, you have not engaged in arbitrage, you have simply engaged in consumption. You have paid $25 to relax. That is valid, but let's call it what it is: entertainment expense, not productivity optimization. Furthermore, the I need this to survive argument misses the nuance of how we pay for things today. The friction of spending has been completely removed, which blinds us to the aggregate cost. The Federal Reserve Bank of Atlanta's Diary of Consumer Payment Choice shows that the amount of cash on a person has dropped from $81 in 23 to just $67 in 24. We are not physically handing over resources anymore. We are tapping, clicking, and subscribing. When the pain of payment disappears, the second rent becomes invisible. This brings us to a deeper, more structural issue that makes this trade-off difficult. The pressure to spend on convenience is not just a lack of discipline, it is a result of time poverty. This is a tangible economic concept. The Levy Economics Institute in 2025 found that approximately 39% of single adults suffer from time poverty. This creates a vicious cycle. You work to earn money. The work creates time poverty. You spend the money to alleviate the time poverty. The spending requires you to keep working at maximum capacity. You are running on a treadmill where the speed is set by your recurring expenses. In this context, asking should I invest or pay off debt is almost a distraction. Now, this does not apply to everyone. If you are in the early accumulation phase of your career, living well below your means and your convenience costs are near zero, then the standard math applies. Compare your loan interest rate to the market return and make the spread. Think about the stability of the asset. When you buy a stock, you are purchasing a claim on future cash flows that are uncertain. When you eliminate a recurring convenience cost, say by moving closer to work to eliminate the second car, or by meal prepping to eliminate the delivery premium, you are purchasing a guaranteed future cash flow. The wealthy understand that wealth is not just a function of income, it is a function of the gap between income and the cost of existence. If you earn $200,000, but it costs $190,000 to operate your life, you are fragile. You are leveraged. If you earn $100,000, but you have engineered a life that operates on $50,000, you are robust. Let's return to the title of our discussion. You have $10,000. Do you pay off the credit card at 20% or buy the market? The math says pay the card. But let's say the choice is between paying off a 4% mortgage or investing. The math says invest. But here is the third option. What if you use that capital to permanently eliminate a recurring friction? We have to look at the concept of commuting subsidies again. Remember that statistic. Only 10% of workers get help getting to work. That means 90% of you are subsidizing your employer by paying for the transit. There is a valid critique here that this approach sounds regressive, that it suggests we should all go back to churning our own butter and walking 10 miles to work. That is not the point. The point is intentionality. The danger arises when convenience shifts from a tactical tool to a fixed overhead. Consider the compounding effect of these choices. If we go back to our earlier inflation stat, childcare, rising at 5.2%, we see the danger of fixed cost inflation. When you lock yourself into a lifestyle that requires high inflation inputs, your personal inflation rate will always be higher than the government's reported CPI. Investing in the stock market is an attempt to outrun this inflation, but it is much easier to step off the track. The wealthy often choose to pay off debt, not just bank debt but lifestyle debt, because it reduces their exposure to these inflationary pressures. If you own your home, outright rent inflation does not hurt you. If you cook your own food service sector, wage inflation does not hurt you. So how do we operationalize this? First, audit your second rent, distinct from your primary rent or mortgage. Tally up every recurring cost that exists solely to save you time or effort. Second, look at your time-poverty ratio. Are you spending this money because you are truly working every waking hour, or are you spending it because the infrastructure of your life is inefficient? Third, apply the yield test to your convenience spending. If you cut your dining out budget by $500 a month, that is $6,000 a year. To generate $6,000 a year in passive income from the stock market at a 4% safe withdrawal rate, you would need $150,000 in capital. That is the math that the wealthy understand. There is a moment in every financial journey where you have to stop looking at the return on investment and start looking at the return on lifestyle. The narrative that you must invest early and often is true, but it is incomplete. It assumes that your burn rate is static. It assumes that you are a fixed vessel that just needs to be filled with money. But you are not a bucket, you are a pipe. As we move further into a world where everything is a subscription and every inconvenience can be solved with a biometric scan and a recurring payment,